Hey everybody, Rob Maurer here, and today we are going to go through our Q2 2021 Tesla earnings preview. I'm going to go through all of my estimates as well as you can see on screen here, the analyst consensus estimates, and we'll see how we compare and if Tesla might beat earnings for Q2. Before we get into that though, a couple of reminders here. So if you are an audio listener, this is pretty spreadsheet heavy, obviously, with being an earnings preview. So I'll put the link to the video down in the show notes. Check that out. Probably a little bit easier to listen to than just the audio in this case. And then as we talk about every quarter, really the reason that we do these earnings previews is just to get an understanding and provide context for, what Tesla actually ends up reporting, which is obviously going to happen on Monday. So the reason I want to walk through the details of these and try to predict some of these things is just so that when we get the numbers, we have a better understanding of what they mean, and most importantly, what they mean for Tesla's future, not necessarily just trying to isolate in on this one quarter. So we'll talk about some of the details behind that train of thought as we go through. But other than that, let's get started here. So I think you guys can hopefully see this pretty well. It's a little bit simpler than the production tracking spreadsheet, but we're just going to go through top level numbers. So revenues, then cost of goods sold, that'll factor into the gross profits that we're talking about. Talk about gross margin percentages, operating expenses, and then bottom line earnings. So you can see here, my forecast we'll walk through. That's going to be in the white. The year-over-year change is just going to be on the side here, so we can talk a little bit about that. And then the analyst consensus is going to be over here on the right. So I have two columns here. One of them is the company compiled estimate, so that's just Tesla collecting the different estimates from, I think, about 25 different analysts and averaging them out. That's the consensus that we see here. Similar logic with the other column here. This is fact set. So this is probably what we're going to see the media report on. I put the date in here, July 21st. So that is the last time I had the fact set update. That definitely could change before Monday or even on Monday for what actual media outlets are going to report on in terms of Tesla's expectations. So that being said, let's get into my forecast. I've got 201,328 deliveries here. We don't need to talk much about that. That's obviously been reported by Tesla. Usually they increase that with their actual earnings report by 100 or 200 vehicles. So that's why I have just a slightly higher number there. But let's get into the sales numbers. So for automotive revenue, I'm expecting just below $10 billion, about $9.9 billion, of which regulatory credits I have at 500,000, so 500 billion. Regulatory credits every quarter are one of the most difficult things to predict, and they have a huge influence on how the rest of the numbers shake out. So I've gone here and just put them relatively close to what we had seen in Q1. Somebody on Twitter a while ago actually pointed out that I have consistently under forecasted regulatory credit revenue for 6 quarters in a row. Albeit one quarter I was only about 0.5% off, so it's basically right on. But I have been pretty consistently low on this, and part of that is intentional because I do like to be conservative on that because it does have such a big influence. But part of that is just me probably being probably being a little bit too conservative in terms of my forecast. So I'm trying to be a little bit more aggressive in this case because of that. And I'm doing 500 million. But we definitely could see more because in Q1 they did 518 million, and Q2 obviously more cars were delivered. So with Tesla delivering more cars, perhaps they sold more regulatory credits as well. Hopefully I'm a little bit conservative on that, but hopefully not anything too off. If you see the analyst consensus, they are a little bit lower on regulatory credit revenue, so about 400 million, but higher on total automotive revenue. So they're expecting more revenue just from actual vehicle sales than what I am, and lower credit revenue. So basically just on higher average selling prices is the difference there. I'm thinking maybe they're a little bit higher on Model S and X, and maybe a little bit higher in China, but this is about all the breakdown that we get. So we'll talk a little bit more about that here in a second. Let me just wrap up the revenue, and then we can kind of come back to automotive. That's the big driver. So energy sales, I have at $640 million. That would be up pretty significantly quarter over quarter. Not quite 50%, but pretty close. So we had 494 million in Q1, but that was down really quite a lot from Q4, which caught a lot of people by surprise. If we scroll down here, I've got the energy storage numbers. You can see we did Tesla did 445 megawatt hours in Q1, off of almost 1,600 megawatt hours, 1.6 gigawatt hours in Q4. So that was a super sharp drop. They did a little bit more in solar, but obviously that drop in energy storage contributed to a significant drop in energy storage revenue. So this is a pretty big unknown this quarter. If Tesla returns to kind of those Q4 levels, or if it's more in line with kind of like what Q1 was at. And I've kind of split the difference. So I'm at about 825 megawatt hours being installed. I'm continuing to see a little bit of a ramp up in solar. So I'm at 99 megawatts of solar installed, and that's getting me to 638 million in energy. We did also see last quarter, the average selling prices in the energy business were really weird. At least in the model that I've got, it seemed like energy storage revenues dropped significantly more than, or average selling prices dropped more than you would have expected. So I got to be honest, I'm a little bit thrown off in terms of what I've been forecasting and where it came in. So hopefully we'll get a good data point here, but it is something that I don't have a high degree of confidence in here. That being said, I am a little bit higher than the analyst consensus there. So as I said, a little bit lower in automotive, a little bit higher in energy, and then service and other we don't have to spend much time on. I'm at about 950 million here for services and others, about 80 million higher than the analyst consensus, which at the end of the day brings me pretty close to the total analyst consensus of right around 11.5 billion for both of us. That is a little bit higher in terms of the company compiled. That's a little bit higher than what the FactSet estimate was. So again, that may come up a little bit over the next couple of days. So those are the top line numbers. As you can see, I guess that would technically qualify as a beat a little bit, but not really. Just rounding out a couple of those points on the automotive revenue. So Q1 average selling prices were lower than I expected. This number basically came in lower than what I had forecast in Q1. So I want to be conservative a little bit with my ASPs in Q2. In Q2, we did see Tesla increase their prices on the Model 3 and the Model Y pretty significantly throughout the quarter. But because that mostly happened in North America and Tesla does have an order backlog, not all of that pricing adjustment is going to hit Q2 because some of those orders in Q2 are going to be delivered in Q3. Some of the orders from Q1 were what were delivered in Q2. And a part of that is the standard range Model Y. So that only existed for a little bit. But some of those orders in Q1, those are going to fall into Q2. So I'm trying to be pretty conservative with my average selling prices there. We did also have the Plaid Model S start shipping. But we may have also had some leftover inventory. So I've got my average selling price there at like 110,000. This is probably too in the weeds for that section, but just trying to go through some of the ASP stuff that I've been thinking about. Just checking my notes here. Regulatory credits. Sometimes Zach Kirkhorn, CFO, will talk about those. He didn't really say anything about them in the Q1 call, so that's another reason we just don't really have a high degree of confidence, and I'm kind of just carrying forward what Tesla reported in Q1. So let's get into the profit. I'll kind of show both of these at the same time, the profit and the profit percent. So I think I say this every quarter, but one of the first metrics that I look at when I open up Tesla's report before I even look at revenue, because we pretty much know that within a few percentage points due to the production and delivery report that we got in early July. But what we don't know is how well Tesla controlled costs and how well that's improving quarter over quarter. So the first thing that I tend to look at is this automotive gross margin X credit line. So that's going to take away any impact from those regulatory credit sales, and we're going to be able to see naturally how Tesla's margin has progressed from quarter to quarter. So in Q1, Tesla did make pretty good progress here from Q4's levels, 20.7% up to 22.0%, so 130 basis point improvement there. And then I'm at a 24.1% here for Q2, so 210 basis point improvement there. That comes down to basically two things. And I think this is maybe, you can see I'm quite a bit higher on my gross margins than what Wall Street is expecting. That's going to come through down here as well. But I think the reason for that is because two factors. In Q1, Zach Kirkhorn again talked about how they had a $200 million cost attributable to the refresh of the S and X. And he said that mostly fell into cost of goods sold. So that means it is hitting the cost of goods sold. It's lowering the automotive profit by about $200 million. And obviously Tesla didn't generate any revenue from that additional cost of goods sold in Q1. So for Q2, I'm expecting still a hit from that because Tesla's production has still been low, and obviously they still struggled at the first part of the quarter to get Model S up and running. And obviously Model X continues to be a challenge too. So I do have a hit from that, but instead of 200 million, I'm taking that down to about 50 million in Q2. So that's, right there, $150 million improvement. Plus we've got higher revenue on higher vehicle deliveries that's coming through. That'll make Tesla's leverage of their fixed costs better, which is going to improve their margin. The other main factor is that Model Y continues to ramp up both in China and in Fremont. And I think that Tesla's getting a 25% plus margin. I'm pretty confident of that out of Fremont. China still ramping up, so not quite as clear. But because of that higher mix of Model Y, which should also have continuing cost declines because it's been ramping up, we should see really strong margins from the Y, and it's a bigger part of the mix. And that's the other factor driving this up. I'm hoping I'm still actually a little bit conservative on this, but we'll see. It's definitely hard to forecast. As for energy gross margins, you can see I'm at -6% here. This has kind of been all over the board the last 12 months. So you can see, sorry, I should have mentioned this at the beginning, but these are the last 4 quarters, left to right. So last year, Tesla Q2 was about 6% positive gross margin on energy, but that was really when it started to fall. So Q3 last year down to 3.6%, Q4 down to 4.7%, Q1 really, really dropped, and this I think threw everyone off. -20% gross margin on energy in Q1. So that was a $100 million loss from the energy business, which is pretty significant to Tesla's overall business. I'm expecting improvement this quarter, mainly because at the end of Q1 and basically in April, Tesla adjusted their pricing for the solar roof. So you may remember this, a lot of owners had Tesla come back to them and adjust the price that was on their contract, increasing it by, tens of thousands of dollars in many cases. I think that was the main reason for the loss in Q1. So if Tesla was able to adjust those contracts and adjust their, future orders for the solar roof, I'm hoping that'll stem a lot of those losses in the energy business here in Q2. That being said, I'm still going to give them some time for that to make its way through the business because pricing changes, as we talked about with the vehicles, aren't necessarily going to happen, instantaneously when Tesla makes that call. So I'm hoping to see some improvement there. That was really a drag in Q1. Let me just see, just quick glancing over to my notes here and making sure I didn't miss anything else. One thing that I did mean to mention when we were talking about the automotive gross margin. So Tesla in May, remember, in the United States at least, removed the radar for Model 3 and Model Y. I expect that to be about $150 savings, thereabouts, maybe $200 or so on each vehicle. And that actually ends up being pretty significant. So we should see cost improvement from things like that too. Some of that's going to be offset potentially by higher supply chain logistics costs. Obviously materials prices worldwide are rising. Manufacturing is an expensive business to be in right now for everybody. So that's going to potentially offset some of these improvements in margin that we've been talking about. However, Tesla dealt with a lot of that stuff in Q1 too. So hopefully that's a pretty decent baseline already counting for some of those things. But anyway, radar will also help with the costs there in Q2. Okay, so services and others. Here I've actually got a quote from Zach. I think I do, hopefully. I may not have actually pulled it into my notes, so give me 1 second on that. But I am thinking that we're going to see a continued improvement in services and others in terms of margin. This has been a pretty big loss business for Tesla historically. You can see here, in the previous 4 quarters, aside from, before this one, Tesla lost $350 million in services and others with average margins, -15%, -14% there. I'm expecting that to improve again, like we saw in Q1. Dramatic 14, percentage point improvement there. I'm expecting that to go pretty close to break even now this quarter. I just have a $30 million loss. I wouldn't be surprised if that actually did move positive. The question for me is, I think Tesla, they put their used vehicle sales in the services another line. And obviously used vehicle sales margins right now should be incredibly strong. But I also just don't know exactly how much available inventory Tesla's got there to be able to sell. That kind of depends on trade-ins and things like that. And, obviously if you look for a used Tesla right now, there's very few available. So I think the margins will be good, but I guess I don't really know as much on the revenue side if it's going to be enough to drive that whole business positive when accounting for actual service costs. The quote there that I wanted to read, let me just see if I can find it here super quick. I won't wait too long on this, but yeah, so I've got this quote here from Zach. He says, on services and other margins, these have recovered and are trending toward profitability, aided by strength in the used car business, operational improvements in service, and additional service revenue opportunities that help absorb fixed overhead. So that is what he said in Q1 in regards to service. So I think we'll continue to see an improvement there and maybe even see that shift into a positive margin or break-even business for Tesla. And that's going to help overall. So just kind of rounding that out then, you can see here my total gross margin percent, I'm at 23.4%. That does include the regulatory credits. So really, it's better to compare these numbers. I'm about 100 basis points higher on automotive gross margin X credits, but then I'm a little bit lower on service, but a little bit lower on energy, a little bit higher on service. At the end of the day though, all things factored in, I'm about 110 basis points higher for my gross margin forecast than what the street is expecting. Okay, so now we're getting into the operational costs, then we'll wrap it all up with the bottom line numbers. So here you can see we did see a pretty big spike in research and development in Q1. So that shot up to about 666 million from 522, and that was already quite a bit higher than Q1 and Q2 levels last year, Q2 and Q3 levels last year. So I've got another quote here from Zach on R&D. He said, quote, this includes the structural battery pack and 4680 cells, investments in the new S and X, and our neural net and silicon investments. So I think a lot of those are probably expenses that are going to continue here in Q2. Maybe not all of them. Hopefully some of the S and X R&D is reduced. So I'm at 650. I think that's a little bit conservative. It's slightly down quarter over quarter. I wouldn't be terribly surprised to see it go back maybe to 550 or 600, depending on that S and X stuff. But some of that R&D expense could still be falling in this quarter. Obviously, Tesla's still been working on those things. Bitcoin, or I guess we got to go SG&A first, then we'll get to Bitcoin. So, oh, and by the way, there's no forecast here for the analyst consensus. And another thing that I just remembered that I wanted to say earlier is that I do my forecast before I even look at this consensus. So some of the numbers are close, but that's just because we, ended up at the same spot. It's not because I'm basing any of my forecast off of this. I do it completely before I look at this. So that being said, let's go back to SG&A here. In Q1, we saw a pretty sizable jump in SG&A, selling general and administrative costs, from Q4 and also from Q3. These two numbers here, these were driven pretty significantly by Elon Musk's compensation plan. So stock-based compensation is a huge portion of the SG&A costs. And you can see here, I've got stock-based compensation broken out. And we saw a pretty big jump here. So this would be Q2 last year into Q3. About $200 million more there, and then another $100 million in Q4. And that kind of stayed similar in Q1. Here are the CEO compensation plan recognitions that we've seen the last 4 quarters. So you can see this really jumped up last year in Q3 and Q4, and that kind of continued into Q1. I actually expected it to be a little bit lower in Q1, but we're just getting to the tail end of that CEO compensation plan. There's just, I think, maybe like $650 million left to expense. So that's going to continue to, we're not going to see another $338 million quarter, or if we did, that would, take out half of the remaining CEO compensation. So I expect something more like $167 million. Let me just show my stock-based compensation number here. So you can see I'm projecting a drop, and most of that drop, or I guess the entirety of that drop, is just because I don't think there's going to be as much CEO compensation this quarter. I think for non-CEO stock-based compensation, I just did about a 5% increase quarter over quarter on that. But that's coming back in then through the SG&A. So I'm I'm forecasting about $100 million less in SG&A spending in Q1, primarily because of entirely because of that lower CEO compensation. What that means is that Tesla's operating margin, their operating leverage, is going to improve because there's less of an outsized impact from Musk's CEO compensation plan. We've talked quite a bit about this. It's definitely important to acknowledge those costs, but all those costs have kind of compacted here into 2020 and now the first half of 2021, just because Tesla's market cap has skyrocketed. So like a lot of the tranches that built that plan just all happened at once. So all that compensation really just, got isolated in a few quarters when it was meant to be spread out over a long period of time. So we're going to return to more of that spread out compensation, and that's going to lower Tesla's SG&A costs. That's going to improve their operating margin and falls down to the bottom line. So here you can see, or I guess now we get to talk about Bitcoin, then we'll talk about the total. But Bitcoin kind of offsetting that. So last quarter, we actually benefited from Bitcoin because Tesla did sell some, their liquidity test. So they had about $100 million gain on that after accounting for impairment and the actual gain on their sale. This quarter, we only have impairment. My guess. I think Tesla's probably not sold anymore. If that's the case, I have forecast impairment to be about $120 million. We won't spend a ton of time on that in this. It's not super important. Basically just means that Bitcoin has dropped a little bit below the lowest price last quarter. And when that happens, unfortunately, just because of accounting rules, Tesla has to acknowledge the lowest price as what they're basically accounting for it on their earnings. So if Tesla didn't sell, I'm guessing my forecast is that's about $120 million. It has no impact on the business, but unfortunately Tesla has to account for it. And that comes in as an operating expense in the restructuring and other section. So with that included, operating expenses actually do end up growing a little bit just because last quarter it was a negative impact on expenses. This quarter it's a positive impact on expenses. So operating expenses at about 1.7 billion. I'm pretty close to the street there. But again, I've got higher profitability. So, my gross margin my gross profit's at 2.7. They're at like 2.55. So when our operating expenses are pretty close, more of my profit, or because I have higher profitability, more of that's falling to operating income. So I'm about $100 million higher on operating income, putting my operating income margin at 8.4% versus the street at 7.6%. So I'd be up 300 basis points from Q1. And remember, that does include the negative impact from Bitcoin. If that were deleted, I'm not sure if I have the formula set up that way. Yeah, I do. If you don't account for the Bitcoin impairment, then you see the operating margin under my forecast jump up to 9.4%, which actually would be an all-time high, higher than Q3 last year, where Tesla was at 9.2%. Yeah. Okay, so let me get that back. And then let's go to the bottom line here. Actually, let me just make sure there was nothing else. Oh, so on SG&A, not factoring in the CEO compensation stuff, the stock-based compensation, I am expecting basically the base SG&A that Tesla's actually paying aside from stock-based compensation, actual costs, dollars costs. I'm expecting that to increase. So Zach on the Q1 call said that, quote, on the SG&A side, we're setting up infrastructure and support for both China and EMEA in anticipation of volume to come there. So this is what we've been talking about with Tesla for like 3 years. If you've been listening to Tesla Daily, actually since like 4 years now, is some of these costs come ahead of revenue. And that's what's happening right now with SG&A, per Zach's comment there. They're building out their teams to be able to ramp up production and deliveries. But that revenue is not happening yet. Obviously, Giga Berlin, Giga Texas, they're not producing revenue yet, but Tesla's hiring people and getting their staff and infrastructure built out in preparation of those actually delivering revenue in the future. So the SG&A right now is going to be outsized as Tesla bears some of those costs until that revenue starts coming in. So factoring out stock-based compensation, I'm still actually expecting SG&A costs to increase. The only reason I have that decline is, again, that CEO compensation. So kind of rounding that point out, this is kind of one of the first lines I look at after I look at automotive gross margin X credits, because this these things, not Bitcoin, but SG&A and R&D, give a really good sense of how operating leverage is developing over time for Tesla, and that's one of the most important factors in the business and how it grows. All right, I think that covers my notes on that section. So let's move on to bottom line numbers here, and I'll skip right to EPS. I know people are always wondering about that. So, shoot, I messed up my my little F4 repeat trick. So there you go. There is my bottom line non-GAAP earnings per share number, $1.07 per share. That does include the Bitcoin impairment. If you take that out, that's about 10 cents earnings per share. But Wall Street should be, their number here, 94 cents per share, should be factoring that in. So I'm at about 13% or 13.13 pennies, 13 cents beat on a non-GAAP diluted earnings per share. On a GAAP basis, I'm at 11 cents. So basically, I'm forecasting a little bit higher stock-based compensation. Those are the only differences between non-GAAP and GAAP earnings per share for Tesla. That's because that's a non-cash cost. So let's see. Anything else to point out here? What this gives me, I guess we'll go through the numbers. So we already talked stock-based compensation. Non-GAAP net income, $1.2 billion. I believe that's a record. I think last quarter was already a record, just over $1 billion. I've got Tesla beating that again. GAAP net income, $728 million, quite a bit higher than last quarter, $438 million. Again, I believe that's an all-time record. And you can see here the leverage in the business developing. So again, this is the year-over-year column. Net income on a GAAP basis up 600% year over year. So 7x what it was last year, with deliveries up 122%. That's the leverage coming through. Even profits only up 122% year over year, but earnings up 600%. So when people talk about Tesla's price to earnings ratio, they should probably consider that in a single year, Tesla grew earnings by 600% quarter over quarter, or on a quarter comparison basis. On that point, and I did tweet about this earlier, if I look at my earnings per share here over what will become the trailing 12 months, so we'll throw out this Q2 10 cents from last year, and we'll add in the 64 cents from this year. That gets a earnings per share, factoring in like the decimal that you can't see here, of $1.53. So we were at $1 before. Now we're going to move up to $1.53 after this quarter if my forecast is correct. If the Wall Street consensus is correct, take 11 cents off of that, it'd be $1.42. But when I looked at after hours price today, it's like $643.60 or something like that. And then you just divide the price obviously by the earnings, so $1.53. It came out to a PE ratio of 420.69x. Just unbelievable. Like, obviously that doesn't matter, but it just, I don't know, it was mind-blowing because I just wrapped up my forecast. Anyway, whatever. That doesn't matter. The point is that right now the PE is like 650, and after earnings, it could drop down to 420, and that includes this $120 million impact from Bitcoin. If you take that out, that adds another, 10 cents earnings per share or whatever, and that would bring the PE ratio basically right down to 400. So a few months ago, I was talking about how everyone that was saying Tesla was overpriced because the price to earnings ratio is 1,000 or whatever it was at that point, over 1,000. Yeah, it's only been 4 months since then, and the price to earnings ratio has dropped down to 400 now. So 6 months from now, it'll continue to decline as these numbers get replaced by bigger numbers in the future. So yeah, it's important to look forward when considering those PE ratios. And then obviously that, over the last 12 months, these numbers all include these really big CEO compensation plan numbers, which next year, it's going to be more like $150 million a quarter rather than $250 million a quarter. And it's going to be on larger profits and revenue. So it's going to be a smaller number on a bigger base, which will really, really change the GAAP earnings. As for free cash flow, I don't forecast that anymore just because I don't find a ton of value in doing that. I would have to know Tesla's capital expenditures and things like that, and it's just kind of hard. So I punt on that one, but Wall Street's expecting slightly negative free cash flow. I would expect positive based on my numbers. Even just assuming everything else is constant, you can see my GAAP net income is about $120 million higher, which would pretty much eliminate any negative free cash flow. But just regardless of that, I would still expect a little bit higher. Although, now that I'm saying that out loud, Tesla did produce more vehicles than they delivered. Whenever they do that, that's going to hurt their working capital. So that could be a factor in negative free cash flow. Either way, not something I'm concerned about. That'll just swing back the other way next quarter if deliveries are more equivalent to production. Okay, so I feel like it's just a lot of talking, but hopefully that was clear. Let me just run through my notes one more time and make sure that there's nothing else, and then I'll just pop in a chat if anyone's got questions. Let's keep them related to earnings, and I'll just make sure I didn't miss any super chats earlier. But yeah, hopefully that was smooth enough. We only got 2 dislikes, so at least I know the audio's been working then. Thanks, John, for the super chat. Thanks, Kyle. I put Kyle in charge of moderating the chat. I hope he's done a good job. Super chat here from Joel. Let's see if I can add that. Rob, any chance the Maxwell Korea sale would offset Bitcoin impairments? That'll be Q3. So no. I think they announced that July 15th. So, but hey, if there's impairment in Q3, that Maxwell selling off some of those assets could help. I don't think that's going to be a huge. I'd be surprised if it's more than 100 million. Probably in the tens of millions range. Okay. Awesome. Thanks, Winston. Really appreciate that. I will have a nice weekend. I hope you all do too. Thanks, Tony. Again, I'm just scrolling through here to make sure I didn't miss any super chats. Eugene asking, tell us Tesla stock price prediction. Yeah, not really my game. My prediction is it's higher in 2030. That's my prediction. Thank you, Dennis. Thank you, Bradford. Something about China credits. Yeah, I'm not really sure on China credits just because we had that report earlier on, I think that was yesterday, about the credits accumulating from 2020, and now Ministry of Industry and Information Technology just started allowing those credits to be traded through August 31st. So I think there might be an outsized impact from that in Q3, but it's just kind of hard to get an understanding of that. Oh, Bradford was responding to a different super chat here from Laura. I see. So Laura said that Stellantis said that they don't need to buy any more regulatory credits. Yes, but I think they said that earlier. It's a good point, though. I probably have to go back and check on when exactly they said that. Yeah, regulatory credits, it's confusing. Very confusing. And Tesla doesn't really help us out with much guidance on that because I don't think they really have much guidance to give. All right, so I think I got through those super chats. I'm very mad though if we come in and get something like $200 million in regulatory credits after I finally stop getting so conservative with it. That's how it usually goes. All right, just getting back to the bottom of the chat here. You may be able to hear my upstairs neighbor walking around. So annoying. It's when I'm recording the podcast, I often have to re-record things because of neighbors. I really need to move. Yeah, that's pretty loud. They also have a dog. All right, I'm just killing time until I get to the bottom of the chat here, which I think I have now done. Thank you, John. Appreciate that. Okay, so it doesn't look like we have too many questions here in terms of the report. So think we'll wrap it up there. I'm trying to think if there's just anything else news-wise that we need to talk about. Obviously, Elon was tweeting earlier today about potentially building a factory in India. I know we've got a lot of listeners there that always get very excited about that for good reason. But it sounded like they're going to try to import vehicles first. Obviously, import taxes in India are they're very high and make that a difficult prospect to do. So I think Elon trying to create some leverage there for them to reduce import taxes on electric vehicles, which are similar to, diesel or gasoline vehicles too. I think I saw one other super chat come in here. Okay, so not super earnings related here, but what do you think about Tesla getting into home construction for homes that seems so lucrative? So obviously we saw Tesla partner with the real estate development companies on that project in Texas near Austin. I think that's probably more the route Tesla will go for, certainly for quite some time. If you listen to Elon talk, he's always talking about how they're constrained on engineering talent. If they were to get into home building, that's a whole other, ball game that's going to require a lot of talent to be dedicated to it. I don't expect it right now. Certainly Elon has interest in, the HVAC space for homes. So I wouldn't write it off as a possibility in the future, but it's not something I expect in the, I guess sort of medium term. Frederick here asking, how much pressure on margins do you see from the ramps of the gigafactories next year? We didn't really see too much trouble. I'm just kind of looking back here. Tesla was able to stay very solidly gross margin positive. I can probably even unhide past quarters. So Tesla was able to stay, right around that 20% gross margin X credits, even while ramping Shanghai, which obviously first deliveries there would have been Q1 2020. And then we had, first Model Y deliveries Q1 2021. And this was only having Fremont. So I think, I don't anticipate a ton of pressure. Certainly there will be some, but I think Tesla will be able to work through it. And Tesla, I think, will structure it where they'll try to ramp production as quickly as possible in that first production quarter so they can get to positive gross margins kind of right away, which is what they were actually able to do. I'm not sure if on the Model 3 from China they were able to do that, but they said the first quarter for Model Y in Shanghai was actually positive gross margin. Doesn't mean it was positive, if you factor in the operational costs, but at least positive gross margin on the vehicle sales. Let me hide those again. Okay. So it's Friday night. I don't want to take up all your guys' night here, but we're at 38 minutes already. Yeah, that was a long one. But okay, so just the game plan for Monday. As I usually do, I'll release at least my plan at least, is just to release a quick recap of the financials and anything in the shareholder letter shortly after they're released. So keep an eye out for that. Good reason to have notifications on for the channel. And then I will do the earnings call so we can all listen to that together. I'll take notes as usual, and then just a super quick reaction there after the earnings call as well. And then over the following couple of days after that, I'll be doing some interviews and things like that just to kind of discuss earnings as well. So yeah, it's a great reason to subscribe and sign up for notifications. But yeah, I hope you guys can all join me for the earnings call. It's always fun to get the numbers. And again, hopefully this helps us kind of understand what we're looking at when those numbers come out, and how they might influence future quarters, which again, I can't reiterate enough. One of the biggest influencing factors on future quarters is this automotive gross margin X credit number. If Tesla beats on that means great things for Q3, especially as Tesla's continued to increase their prices. So yeah. All right. Hopefully I didn't miss anyone's super chat, but thank you guys for all tuning in. Appreciate that. Have a great weekend. As always, thanks for listening. You can also find me on Twitter at Tesla Podcast, and I'll see y'all on Monday for the July